You go first.
You will be in the
We'll
middle.
figure it out.
All right.
It's all good with me.
All right, thank you everyone. Very happy to be here, very grateful to be with legends, Adam Back, Michael Saylor. I think we can all be grateful to have the privilege to spend time and get all the knowledge of Michael and of Adam all together. But first, I would like to express my deepest gratitude to BTCPrague. I think they have put together an amazing event. Thank you so much. Thank you, Matthias, Martin. I think we can all say every time there is no second best, but then you meet Matthias, you say there might be no second best, and then you meet Martin, and then there is maybe. And so thank you so much for all of this. And I would like also to thank very much Michael and Adam. I think on a personal level, you have changed my life and my family. And I think that's the case for a lot of people here. I think that you are an example of ethics, of courage, and of success over the years, and that provides a lot of hope for everyone. Well, I guess everyone agrees, so thank you very much. I guess a key topic here today will be the financialization of Bitcoin, and maybe we will get into how this is also positive for Bitcoin, what are also potentially some risks and trade-offs to always take in mind. But first, I would like to start with Michael and to ask, how is it possible that the simplest, the clearer model for business is actually the most effective? I asked just before entering the stage to the community on X, what is the #1 question I should ask? And the question always I get is, what is the next business model for Bitcoin Treasury company? Well, the business model, you already have it. And so I will leave the floor to Michael to explain how the model is so robust due to its simplicity and how you can achieve amazing results by focusing on executing it as laser eyes focused as possible and to deliver the best results for shareholders.
Thanks. You know, I said in Vegas, you know, a corporation is the most effective wealth creation machine that we have yet devised. And if we think about the spread of Bitcoin as a monetary virus and as an idea, the super spreaders, the amplifiers of the virus are corporations. When Bitcoin hits an individual, if Bitcoin arrives, you know, at my proverbial dentist, and the dentist clocks a couple $100,000 a year or whatever, they're buying a few $100,000 of Bitcoin. And you know, as I said, in the war to determine the future of money, right? It's going to be fought with money, right? Right? The future of money is going to be fought with and won with money. So the dentist is, he's generating a few $100,000 or she's generating a few $100,000 a year. And so over 20 years, you're going to buy $4 million of Bitcoin. When the dentist incorporates and becomes a company, the dentist is going to sell $1 million of stock, and they're going to buy $1 million of Bitcoin in a month. And when the company recapitalizes on Bitcoin, then your real opportunity is to any operating company can sell equity or sell credit, issue credit. And public companies are the best. So say you're a public company, the superpower you have as a public company is you can sell equity, you can issue warrants, you can issue bonds, convertible bonds, junk bonds, or preferred stock. And the preferred stock can have any rights. It can look like equity, it can look like convertible equity, it can look like a bond, it can have dividends or not. So when a company adopts the Bitcoin standard, that dentist that becomes a company doesn't buy $1 million of Bitcoin in 5 years, doesn't buy $1 million of Bitcoin in 1 year. The company issues $1 million of equity and buys $1 million of Bitcoin in 1 month. But it's immediately profitable, which means in the next month, the company can issue another million. And so a company may very well start to issue $1 million a month of security, of equity, and then all of a sudden it's bought $10 million of Bitcoin. So now the interesting thing is, where is all the money in the world? There's $100 trillion of money in the equity capital markets. There's $300 trillion of money in the credit markets. All of the equity capital in the world is valued based upon future expectations of fiat cash flows. Every company in Nigeria is valued based upon the expectation of Nigerian cash flows. Every company in Brazil is based on Brazilian cash flows. Every company in the US, US cash flows. Okay, and we know that the value of that cash is falling, but we also know it's very competitive. So you have a long, heterogeneous, uncertain, like credit risk there, or a equity risk, we'll call it. And then with credit, all of the creditors, they're valued based upon the future expectations of cash flows. I borrow money, I don't have the money, I promise you I'll pay it back, I'm going to get the money over 10 years, right? So the existing markets are based upon these future expectations of business operation. We're valuing real world assets, we're valuing future cash flows, we're valuing equity or opportunities. And the Bitcoin Treasury company idea and the most elegant business model is, I have a stack of Bitcoin, $10 million of Bitcoin. I start issuing equity based upon my ability to acquire more Bitcoin. Then I issue credit, fixed credit, convertible credit, some other credit, and then I use it to buy Bitcoin. And of course, the point is, when MetaPlanet was a hotel, they might be able to buy $1 million of Bitcoin a year. But when MetaPlanet started issuing equity, it's able to issue $1 billion of equity in a year. And so now they're buying not $1 million, but $1 billion a year. But the rate at which a company can issue equity or credit is exponential, but it's not like annual. You might be doubling every month, right? You might go into something like on October 30th, we announced a $21 billion ATM. We thought, well, if we do that in 3 years, that'll be the most successful equity program in the history of the capital markets, if we did it in 3 years. And we did it in like 3 months. Because all you're doing is you're swapping equity for Bitcoin and you're swapping credit for Bitcoin. Companies can do that. Individuals can't do that, but when you put 3 individuals together and they cooperate, they become a company. So really, I wouldn't be afraid of a company. I would just say a company is when, one dude that knows finance got together with one lawyer and got together with one leader, a CEO, a CFO, a general counsel. Now you have a Bitcoin treasury company. If you put Bitcoin, digital capital behind it, and now you can grow literally as fast as you can issue the security and buy the Bitcoin. And that is an investment cycle which is 1,000 times faster than a physical real estate cycle or a business cycle. So it's faster, it's homogeneous, and primarily the friction point is the issuance of securities. So it's a legal and it's a regulatory friction point, and it's different if you're Japanese than if you're French. You need Bitcoin treasury companies in the UK that understand UK law, and one in France and one in Norway and Sweden and Germany, and they're all going to have local advantages because they're, if you're a Japanese company, it's easier to issue Japanese securities than an American company going to Japan. I know this. I called Simon. I said, Simon, the good news is you'll probably beat me to issue preferred stock in the Japanese market. go for it, right? And so I think that's the simplicity in the business model is I'm just going to issue billions and billions and billions of dollars of securities and buy billions and billions and billions of dollars of Bitcoin. And I'm going to digitally transform the equity and the credit capital markets from 20th century analog physical cash based to 21st century digital Bitcoin based. And that's, I think, what we see right now in the market.
That we are going to a BTC denominated world, the $200 trillion opportunity in today's dollars, and the future of as well the accretion and the Bitcoin per share and the MNAV and the premiums and so on. Many of these, Michael, you have been pioneering the BTC denominated capital markets with the KPIs, the BTC KPIs, the BTC yield, the BTC gain, and the torque, and you have been putting together a lot of metrics for the financial industry overall to be able to value Bitcoin treasury companies. And you are also aggressively now tapping into credit markets, and you are issuing new products that allow to maybe challenge this form of consensus view that the premium should go to 1 over time or something like this. Effectively, with the instruments that you are leveraging, potentially you are enabling the premium to continue to stabilize or even go up. So how are you able to provide financial engineering in a best-in-class manner to tap into those capital markets and have the best performing preferreds and have the ability to make an announcement of 10,000 Bitcoin in a week? And how are you able to do that, and how this is shaping the new wave of adoption for financial markets with the instruments of Bitcoin treasury companies?
You know, I think our first challenge was to develop a set of metrics that you could use to value BTC-backed equity. And because you're on a Bitcoin standard, simple USD, US dollar accounting doesn't really work, because US dollar accounting is geared toward companies that generate their earnings via operations. And so, we created BTC yield, which is basically the accretion of Bitcoin per share in a percentage. And the idea of that is if you've got a 20% BTC yield, you could put a multiple of it on it like 10, and you could come to a 200% premium to NAV. It's a very simple way to get to what should the premium to NAV be. Well, it comes down to whether the company generates 220% yield or 10 or 200% yield, right? And a bond that pays 200% interest after tax is worth a lot more than a bond that pays 5% interest after tax, right? So the yield metric was an equity metric. BTC gain or dollar gain is an equity metric. BTC dollar gain is basically the earnings equivalent for a Bitcoin company. It's on a Bitcoin standard basis. If you generated $100 million of BTC dollar gain, it's like $100 million of after-tax earnings. It goes direct to shareholder equity. It bypasses the P&L. But a company that can generate $1 billion of BTC dollar gain is like a company that generates $1 billion of earnings, right? And you could use a P to E on that and say, well, I'll assign a P to E of 10 or 20 or 30 or whatever times that gain, and that gives me an enterprise value for the operation and their ability to do it. Now the question becomes, how do you generate BTC yield, and how do you generate BTC dollar gain or BTC gain? And there's 3 obvious ways to do it. One way is operating cash flows. I take my operating profit and I sweep it into BTC, and that becomes a yield, and that becomes a gain. That is, I have $100 million of operating cash flow and I buy Bitcoin with it. Then I have $100 million of BTC dollar gain without any shareholder dilution, right? And so that's one way to do it. You need an operating company that generates a lot of cash to do it. The second way to do it is if you sell equity at a premium to NAV, You know, when you're selling $100 million of equity at a 2 mNAV, then you capture a $50 million BTC dollar gain. And of course, if you sell equity at a discount to mNAV, you're actually diluting the shareholder. So you would have a negative yield, a negative gain. I think the reason that BTC yield and BTC gains matter is it's a very simple, transparent, instantaneous way for an investor to see whether the management team took an accretive transaction or a dilutive transaction. On any given day, any public company can raise almost any amount of money if they're willing to dilute their shareholders. And the real trick is to do it accretively. So those two metrics, you know, are important, but now we've moved through this issue. I've run out of cash flow. What do you do if the BTC, if the mNAV is 10 or 5 or 8? This is not a complicated question. When you're on fire with an mNAV of 8, you sell the equity, you buy the Bitcoin. You know, at an mNAV of 10, you've got like a 90% spread, right? So you're generating $900 million of gains for every $1 billion of equity you're selling. It's risk-free, instant earnings, in essence. That's not complicated. The question is, what if mNAV goes to 1 or it goes below 1? How do you, what if you don't have any cash flow and mNAV goes to 1, but you have $1 billion of Bitcoin on the balance sheet? Well, if you're a closed-end trust like Grayscale, right, or if you're an ETF, but especially a closed-end trust, you can't do anything, so you'll trade at a discount to mNAV, and that's always the thing people wanted to avoid. The special power that an operating company has is to issue credit instruments, though. And so the way that you actually pull yourself out of a hole if you trade at a discount or you trade down to normal mNAV is you start to sell credit instruments collateralized on the assets of the company. So that takes us to the idea of BTC credit models. If I have $1 billion of Bitcoin, I can sell $100 million of a bond or let's say $100 million of preferred stock that yields 10% dividend yield. It's 10 times over collateralized. So therefore the BTC rating is 10. You can now calculate the risk. The risk would be the risk that your $1 billion of Bitcoin trades to less than 100 million by the time of maturity of the instrument. You can calculate that statistically the same way you calculate Black-Scholes models. You plug in the volatility, you plug in the BTC rating, a risk pops out. And then you can calculate a credit spread, what we call BTC credit. What is the theoretical credit spread above the risk-free rate that you need to offset the risk? And of course, the credit spread, if the BTC rating is 2, is higher than if it's 10. And if Bitcoin volatility is forecast at 50, then the credit spread has to be higher than if the Bitcoin volatility is 30. So if you plug into your model your expectation of Bitcoin return or ARR over a decade, and you plug in your expectation of volatility of Bitcoin, and you plug in the price of Bitcoin, you get a BTC rating. The risk pops out. The BTC credit model pops out. What we have done is used that in order to start to issue Bitcoin-backed credit instruments. Our idea is we want to sell securities into a market that's orthogonal to the equity market and to the Bitcoin market, or an uncorrelated market. So the market for US dollar yield, right, amongst retirees, there are a lot of people that don't know what Bitcoin is, don't know what strategy is, they don't know anything about our business model. But if we offer them, like we offered a preferred stock that yields 10% dividend at par, we offer you 10% dividend yield and a qualified income distribution, a QID or QDI qualified type instrument. If you make less than $48,000 a year, you can buy the instrument and collect 10% dividend yield tax-free in the US. Okay, well, that's interesting. A lot of people want 10%. Now the issue is it risky? Well, if it's 5x or 10x over collateralized, then it doesn't look that risky if you think Bitcoin is a real thing. So the idea of giving someone extremely low risk but high yield fixed income is a simple idea. I think it's kind of a killer application for Bitcoin as collateral. What we did at Strategy is we created a convertible preferred called Strike, which gives you 40% of the upside of the stock and an 8% dividend at par. And then we created a senior preferred called Strife that gives you 10% at par. That is cumulative. It means the dividends, if you ever miss them, they accumulate and there are penalties. And so it's senior to all the other preferreds. And those two were the two most successful preferred stocks in the century. That is the most liquid, the highest performing. They all traded up 25% when the other preferreds were trading down 5%. And of course, they're the most successful because any security backed by pure Bitcoin is always better, right? The options are more valuable, the equity is more valuable, the convertible bonds are more valuable. These preferreds are more valuable because you're plugging in an asset which is going up 55% a year with 55 vol. And so if you plug in something which is spinning at 55 RPM that's going 55 miles an hour, there's a lot of energy in it. So we just plugged that into those instruments. They were very successful. We floated them in the public market on NASDAQ and we attached a shelf registration to them. And the idea is now we can sell people 40% of the upside of the stock, and that might be 80% of the upside of Bitcoin, but with downside protection and a guaranteed dividend. So we call Strike, it's like a Bitcoin fellowship. It's like you get a living stipend, you get protection, and you get to ride the upside and you can hold it forever. And that's for the Bitcoin curious that are afraid to get on the roller coaster, which is Bitcoin, or the hyper roller coaster, which is the equity, the turbocharged Bitcoin and MSTR. But then there's a lot of people that don't want Bitcoin exposure. They just want US dollar yield or Euro yield or JPY yield. And so, how many people is that? Well, that's like every retiree in the world. That's like everybody. There's no one that doesn't want 8 or 10% dividend yield at extremely low risk. That's why the credit markets, fixed income markets are bigger than the equity markets. So what we did there is we're just using Bitcoin to generate that. And if Bitcoin is going up, it's been going up 55%. So you can pretty much slice any amount of yield out of less than 55%, and you can give it to an investor. And I think a Bitcoin maximalist long-term forecast is 30%, but I figure Bitcoin's got to yield between 20 and 60% a year forever. And as long as Bitcoin is returning 20% or more, you can always sell these instruments offering 6, 7, 8, 9, 10% and swap it into 20, 30, 40%. Capture the difference for the equity investors, and that way the equity outperforms Bitcoin. The convertible, you can probably, and here's our engineering, we're basically engineering the company for the equity to outperform Bitcoin by 50 to 100%. Then you've got Bitcoin. If you want straight Bitcoin, you buy it from iBit or you buy the BTC and you hold it yourself. And then we're engineering, but you're getting all the upside and the downside of Bitcoin, all the volatility. Then Strike, the convertible instrument, is engineered to give you 80 to 100% of the performance of Bitcoin, but with 10% of the downside. So we want 80% of the upside, 10% of the downside, and a guaranteed dividend. So that's for people that kind of want to have their cake and eat it too, and they don't want the roller coaster. And it almost is meant to compete with iBit. If you think about it, it's like instead of 100% of the upside, 100% of the downside, no dividend, what if I gave you 80 to 100% of the upside? I don't know if it'll be exactly 100%, but the more we lever the equity, then the more likely the convertible equity becomes equal to Bitcoin performance. So we're shooting to get the convert to perform the same as Bitcoin over the long term, but with principal protection and liquidation preference and with the guaranteed dividend stream. And that's that thing. And it seems like there's a market for people that want the upside without the downside, right? And right, I mean, that's the engineering. I give you the upside, you have no downside, and I pay you a dividend while you wait to get rich. Okay? Which is the smart financial engineers, in my opinion, agree with me. They're like, oh wow, this is a good idea. But a lot of people haven't quite figured it out yet because nobody's ever issued a perpetual convertible preferred stock. The last 10 preferred stocks issued in the last 4 years, the top 3 of the 10 were ours, and they're all perpetual, and all the other 7 aren't. People don't normally sell a perpetual dividend or a perpetual call option because they don't have a perpetual use of proceeds. They can't invest in something for 100 years. And so the Bitcoin superpower is if you're a Bitcoin believer, you think Bitcoin is going to outperform the S&P index forever. And if Bitcoin outperforms the S&P index forever, you can sell a dividend that's less than the S&P forever. And then you can also sell a convertible preferred that outperforms, right? That's good forever. So we engineered that, and then the idea with the fixed is we're going to give someone an infinite duration dividend yielding, and the conventional thinking is you're crazy. You should have a call option in it so you can retire it if interest rates fall. And that's the way a conventional bankers like. They all like, you should put a call option and then you call it. If the interest rates fall 200 basis points, you'll call it and you'll refinance it. But that's the way you think if you sell 144A over-the-counter instruments with a 3-year duration to trade in the over-the-counter market. But those are all crippled 20th century instruments. The way you think in the 21st century is I'm going to put STRF into the market, and I don't care how much I sell in the first week. I'm creating the instrument so that I will maximize the amount of capital I raise over the next decade or 20 years. So we wanted to create the instrument so that if Jerome Powell drops the interest rates 200 basis points, STRF trades up to 150. And when it trades up to 150, the yield falls to 6%. And when so instead of 10, it falls to 6, and then we're able to then sell it. I'm not buying it back. I'm selling it, right? The whole idea is when the interest rates fall, I will be selling billions and billions of dollars of that instrument via the ATM at 150 or 200. And the small thinker thinks, oh, I have to buy it back, refinance it, go back and do a 144A deal with the investment bank with a huge commission to refinance it, and then that'll be illiquid and crippled. And so I don't want to issue a series of crippled, illiquid securities. And by the way, what I'm describing, the entire preferred stock market. All of the preferred stocks, in my opinion, are garbage. Right? You're buying these garbage instruments that are illiquid, that trade $400,000 a day, that yield 6%, that have the credit of a mid-sized regional bank in a state you've never been to with mortgage portfolios you don't understand. And you're supposed to accept 6% illiquid over-the-counter that nobody can buy, instead of something which yields more, which is 100x as liquid that everybody can buy. And of course, the problem is all that corporate credit, all of that preferred, it's all 20th century ideas on 20th century credit models. So what we did is we concluded the killer app for a Bitcoin Treasury company is to issue credit. Bitcoin-backed equity, that's the first app. And yeah, you can do that for a while. But the long-term durable business is to issue BTC-backed credit instruments and issue billions and then tens of billions and then hundreds of billions. And you're not competing against other Bitcoin treasury companies. You're competing against every junk bond sold by every company with no money, every corporate bond sold by an investment grade company. And guess what? We're more collateralized than the best investment grade companies issuing corporate bonds. We have better collateral. So we're competing against corporate bonds, investment grade bonds, junk bonds, private credit, and then against preferred stock in that market. And the idea is we're just going to sell something that is more credit worthy, less risky, better collateralized, that yields more, that's more liquid, that everybody understands. And ultimately the goal is instead of a market of 1,000 preferred stocks with 500 million in the float each that are illiquid, that are garbage, how about one preferred stock with $50 billion in the float that trades $2 billion a day, that yields more, that everybody's heard of, that's backed by Bitcoin, right? And to do that, you just kind of adopt those metrics. And what I just described, every Bitcoin treasury company can copy. I invite you to copy it. I encourage you to copy it, because just like 20 BTC companies issuing equity legitimizes Bitcoin and Bitcoin equity, 20 companies issuing Bitcoin-backed credit instruments will legitimize Bitcoin-backed credit, will accelerate the digital transformation of all the credit markets and create a stampede of capital out of the 20th century defective, crippled credit instruments into the digital credit instruments of the 21st century. And S&P and Moody's and Fitch, they'll all just start to cover that. Everybody's view of credit risk will evolve. The retirees get 200 basis points more yield on something which is an order of magnitude less risky. Bitcoin goes to 1 million, 2 million. As Bitcoin goes up, the collateral goes up, the markets all evolve. And what I'm describing is the way that I see the digital transformation of the capital markets driven by these BTC companies.
Quickly, to end the panel and open for maybe one or two questions, is Bitcoin investment, and as Michael mentioned many times, the right horizon for Bitcoin is at least 4 years, and the best one is forever. And so we talk a lot about Bitcoin treasury companies, and the opportunity is enormous, but we are here for the long term, and I think that the opportunity should be looked in the long term, and to be careful as well in the market. So is there any questions?
Yes, question to Michael. So thanks first of all for being live for making the industry Bitcoin companies. Yeah, so my question is, at least in my view, there is some kind of issue that financial engineering on top of Bitcoin grows, but at the same time we see more and more centralization on the, let's say, technical side of things. I would like to ask if you see this concern, and what can be, I don't know, social, economical, maybe financial ways to fight it. What I mean is like centralization of pools, an amount of nodes that are getting lower and things like that. Like, do you see it as a threat? And if yes, what do you think we could do to fight it?
I don't think it's a threat. I think the network is decentralizing, and I'm not concerned about the pools. I think that the Bitcoin mining network is decentralizing everywhere in the world. It's far more decentralized today than it was during the China lockdowns, when China shut down their Bitcoin mining. And when China was mining half of it, that was sort of centralized, and then it migrated to the U.S. And in the past year or two, it's migrating out of the U.S. and spreading everywhere in the world. And at the end of the day, I don't think the pools have that much power. I think that the power rests with the economic actors, it rests with the economic nodes, it rests with political actors, it rests with the Bitcoin miners, it rests with a bunch of tech providers. There's a lot more parties that are engaged in consensus today. than there were 5 years ago. And I think the mining pools are much weaker and again, largely irrelevant. Any mining pool that wanted to drive any particular policy would and could be fairly quickly overridden by all the other economic actors or technical actors in the space right now. So I actually think Bitcoin is at its most robust it's ever been, in my opinion. And so I think we're good. There's going to be people concerned about everything under the sun all the time, and I think that's healthy. It's healthy that everyone's worried about this protocol change or Bitcoin Core or this mining pool. That's a healthy degree of skepticism, but I wouldn't interpret that healthy immune response for the network being weaker today. The network is far stronger today than at any point that I can remember or point to.
Right. I think Adam gave already a very good answer on the BTC convertible note. So if you have more questions, I'll be available later on. Maybe if there is another question to close the discussion.
Hello, so I prepared it because my English is not so good. So we've discovered that there is a global trust law fraud connected to legal names worldwide, affecting even all KYC processes on the exchanges. And my friend Vito, he has a little gift for you about this. And my question is, you often suggest also before in the talk that you are using company structures to protect yourself. Is it also connected to the names? But what happens if large private or institutional actors continue operating directly under their personal names? What would you recommend to avoid long-term legal risks as the global structure becomes more exposed?
I'm not sure I understand the question. Can you say it again?
Okay, my question is, so on all the KYC exchanges, there is the problem that they use the wrong names. They change it and it's not the legal names as you have it in the passports. So if you act as a company, you don't have the problem. But when you have big investors like institutional investors, they use their personal data, so their normal name, and then you have you have the problem with the tax institutions and with the tax companies because they have changed it. But yeah, he has some information about it if you are not.
Anyway, yeah.
I think that Bitcoin is spreading everywhere in the world, and you can choose to engage with it peer-to-peer with self-custody and bypass the exchanges. I think you can look at Bitcoin as one world of Bitcoin where it's all individuals working with each other, and there are a lot of different ways you can do that, right? I mean, there are various individual strategies or techniques where you're not working with an exchange and you're not working with a company. I think there's a second way to view Bitcoin, which is what if 400,000 companies all trade peer-to-peer with each other and bypass the exchanges and the banks? I think there's a third way to view it, which is what happens if 50,000 banks start to hold it and trade with each other peer-to-peer. I think there's a certain way that people are dealing with crypto exchanges today, but that's dynamically evolving. I think that as the digital assets environment becomes more flexible, I think you'll see an explosion of innovation. And the innovation is taking place at the country level and it's taking place at the individual level. And whatever is the status quo today probably won't be the same in 5 years. And there'll be some countries that will err on the side of more liberty and freedom and privacy. And they will develop very good technologies, and those will probably spread everywhere else in the world. And there'll be other countries that err on the side of KYC and censorship and not privacy. And I think it's not a Bitcoin problem. It's a nation state or citizenship problem. If you find yourself in a particularly hostile nation state where they deprive you of your privacy or your economic liberties, then of course the answer is you're either going to use technology that came from another place, like VPNs and firewalls and the like, or you're going to move. But I think Bitcoin, because it's global, is it's allowing every nation, every actor everywhere in the world to develop technology for layer 2, layer 3, layer 4 protocols as fast as they can. There are things that are being done in countries that you don't live in that would be illegal in your country or not culturally acceptable. And you will probably, as a Bitcoin holder, you're the beneficiary of someone doing something in another place that might, you know, if I own Bitcoin in Cuba or North Korea, I'm getting rich, even though it's illegal to own Bitcoin in Korea and Cuba. And likewise, a lot of good technology will flow from the U.S. into countries that that wouldn't allow it, and there'll be technology that flows from other countries into Europe where it may not be allowable. And I think that's dynamic equilibrium. There's no one answer except for the fact that it's pretty clear that if you're looking for the best answer is going to be a decentralized network like Bitcoin, and then decentralized layer 2 protocols like Lightning. And they are most likely to provide the most sovereign resistance and sound money properties that you could get. There's no second best idea. So you know, a friend of mine says, you know, things aren't necessarily perfect here. That's why we call it Earth and not heaven. And I would say with regard to this, there's always going to be imperfections in people's implementations of Bitcoin. That's why it's Earth, it's not heaven. But the second best idea is much, much worse than that. And what Bitcoin gives us is it gives us hope that if you are stuck in a place where you have an imperfect capability or imperfect execution, somebody somewhere else in the world is probably working on something better. And once they roll it out, it will start to either directly or indirectly improve your condition as a network participant. And so I take that incremental approach, and I don't get demoralized or depressed if I see there's a suboptimal thing. If there's some exchange or some wallet that did something I didn't like, I just accept the fact that we move forward, sometimes imperfectly, 2 steps forward, 1 step back. And that's all human progress takes place. And if you're too much of an idealist and you demand that everything be perfect everywhere at all the time, you know, throughout the journey, you never get started on the journey and you'll never get to a better place. And I think we're moving to a pretty good place right now. And on the margin, you have $2 trillion of economic energy in the network today that is imperfectly distributed to some actors. But 10 years ago, you had a few $1 billion of economic energy in the network. And it's not like the network was more functional then or all the applications were better. So I think we're better off today. And now that everybody sees the excitement, you're about to see the best and brightest minds everywhere in the world start to spend orders of magnitude more money on programming and innovation in layer 2s and layer 3s in order to cure all the problems that you identify. And I agree there's lots of problems in the world. I think that Bitcoin is a movement and a technology and a protocol that provides us with a hopeful path to get to solutions that are better than anybody else has proposed with any other protocol that I am currently aware of. Yeah.
Right. Well, thank you very much all. Before closing, I'd like to say we organize at 1:30